So just to be clear, our estimate is based on an industry loss of $40 billion. So we expect the insurance industry in its totality to have that level of claims that should be paid as quick as possible to the people that have been affected by this tragedy. Swiss Re's position is supporting what is true tail risk for our clients that are operating in California. And when we went through client by client, insurance treaty by reinsurance treaty, the number that we came up to, as you say, was cumulatively less than the 700 million. We think that's a combination of the partnerships and the level of risk-taking that we're comfortable with in this market, and the clients with which we're working very closely to be sure that we get our money to them so they can get their money and payments, claim payments out to the individual policyholders, typically the retail sector that's lost their homes.
John, we've spent a lot of quarters talking about risk mitigation in the industry, just not offering product in certain areas as you mitigate risk around climate change. We're talking in this particular case about highly prized real estate, areas that people do want to live and put very expensive homes on. Are you going to pull back from California on the back of this wildfire?
No, we don't expect to pull back. What we expect to be able to do is take a look at what actually happened, make sure that our models for expected losses are correct given the conditions that we saw the state experienced in January of 2025, make the adjustments to the model, and then feed this back into the primary companies that say this is a new dimension or a new vector of risk. This is the conflagration of the Santa Ana winds combined with 6 months of drought and has created the situation where these losses exploded literally, and unfortunately in the first 24 to 36 hours the normal actions of the fire departments using helicopters and planes was just not possible, and that's why these fires spread so quickly, so aggressively in residential areas. We think we can, in fact, price this risk well. We think we can support the primary companies that are offering insurance in the state of California in the same way we can support insurers that offer private residential insurance in the state of Florida. We just need to be sure the pricing is adequate.
Say, John, actually, when I look at your P&C reinsurance combined ratios, and I look at combined ratios across the board, by the way, good morning to you, sir. Actually, I see no reason why you would pull back. In fact, actually, once you've got the algorithm where you want it to be, actually, I would wonder whether you increase insurance because it's clearly still very profitable.
Well, on a January 1 renewals, that's exactly what we did. Premiums are up 7%, and that includes all levels of business with the exception of U.S. liability, which is an area which we're still concerned that the pricing is not adequate for Swiss Re and, frankly, for the industry. But in all the property, all the natural catastrophe layers that we operate in today, we think the pricing is adequate. We'll continue to view the models. We mentioned the price increases year on year were up about 2.8%. We also think our loss costs were up even more than that, about 4.2%. So there's margin squeezes a little bit for us in 2025, but we still think that this business is profitable. And to your point, the underlying earnings in P&C Re and Corporate Solutions, our two P&C businesses, are robust.